Many people lose money using MACD, not because MACD is useless, but because they buy as soon as they see a golden cross and sell as soon as they see death cross. If that is how you use Nectar ACD, then you are not using nickel indicator, you are pressing an emotional button. Follow me, and we will keep watching the market together, not chasing emotion, but breaking down the logic. Don't forget to like, share, and bookmark. Understanding the concept is not enough. In the previous episode, we covered the basic concepts of MACD, including diff, DEA, the red and green histogram bars, as well as golden crosses and death crosses. But understanding the concept is not enough. In real trading, the most misleading part of MACD is this. It often gives you signals, but not every signal is worth trading. So in this episode, we are not going to talk about what MACD is. We are going straight into practical strategy. In today's video, we will focus on 3 key points. First, what type of market MACD is actually suitable for. Second, how to correctly use MACD golden crosses and death crosses. And third, how to use MACD divergence to identify possible trend reversals. Especially the third point. Many people understand the concept of divergence, yet most apply it incorrectly. MACD is not a magic indicator. Before we talk about strategy, we need to start with the most important premise. MACD is best used in trending markets. In other words, when a stock has already started moving in a clear direction, MACD can help you judge whether the trend is continuing, whether momentum is strengthening, and whether that momentum may be weakening. But if a stock is moving sideways without a clear direction, MACD will often produce frequent golden crosses and death crosses. You see a golden cross today and chase in. Tomorrow, it gives a death cross. You just stop out, and 2 days later, it gives another golden cross. This is why many people say MACD is lagging or useless. But the problem is not MACD itself. The problem is that you are using a trend indicator in a sideways market. So in real trading, the first step is not to look for golden crosses or death crosses. The first step is to identify the market environment. You need to ask yourself one question first. Does this stock currently have a trend? If the price keeps moving back and forth around the moving averages, and the candlesticks move up and down without a clear direction, then MACD signals become much less reliable. If the price is already above important moving averages, such as the 2-0-day or 6-0-day moving average, and those averages begin to spread upward, then bullish MACD signals become more meaningful. Conversely, if the price falls below the moving averages and these averages move downward, the appearance of a death cross on the MACD along with enlarged green bars warrants greater attention. If you want to learn technical indicators systematically instead of just memorizing a few formulas, make sure to follow this channel. Later, I will break down MACD, KJ, RSI, moving averages, and volume into a complete practical trading framework. AMACD, golden cross, does not mean buy immediately. Now let's talk about the first practical strategy, the MACD golden cross. Many beginners use it like this. When diff crosses above DEA, that is a golden cross. Once a golden cross appears, they buy. This logic sounds reasonable, but in real trading, it often leads to losses. Why? Because there are different types of MACD golden crosses. Some are trend-starting signals, some are just rebounds during a downtrend, and some are simply false signals inside sideways markets. So we should not only ask whether there is a golden cross, we need to ask where that golden cross appears. In practical trading, the MACD golden cross can generally be categorized into 3 types. Type 1. Golden cross below the zero line. This means both diff and DEA are below the zero line when diff crosses above DEA. This type of golden cross means short-term downward momentum is weakening, and the stock price may rebound. But remember, most of the time this is only a rebound signal, not necessarily a trend reversal. Because below the zero line, the overall market condition is still weak. So when a golden cross appears below the zero line, you should not blindly take a heavy position. If you trade it, it is more suitable for a short-term rebound strategy. And it is best to analyze in combination with trading volume, support levels, and candlestick patterns. For example, after a continuous decline in stock price, the price stops falling near the previous support level. Meanwhile, the MACD forms a golden cross below the zero line, and the green histogram bars begin to shrink. At this point, it can be interpreted as bearish momentum is weakening and a short-term rebound may be on the cards. However, this is still not the strongest buying signal. Type 2, golden cross near the zero line. This is one of the more important types in real trading. If MACD goes through a period of correction, diff and DEA return near the zero line, then form another golden cross, while the price does not break below an important support level. This usually means the stock is not simply rebounding from weakness. Instead, it may have completed a correction within an existing trend. This type of golden cross often appears in the middle of an uptrend, and its practical value is usually higher than a golden cross below the zero line. For example, if a stock has already seen a previous rally, then enters a pullback, its MACD red bars shrink and even turn green temporarily. However, the stock price does not break key support during the correction, and the moving average structure remains intact. Later, the MACD forms a new golden cross near the zero line, with red bars expanding again. At this time, it may serve as a trend continuation signal. This type of golden cross carries higher practical trading value than a golden cross below the zero line. Type 3, golden cross above the zero line. This means the market is in a relatively strong area. When both DIF and DEA are above the zero line, it suggests that the medium to short-term trend is bullish. If MACD forms another golden cross after a correction, it may signal a second stage breakout in a strong stock. But there's also a risk here. If the stock has already risen a lot and is far above its moving averages, a high-level MACD golden cross may not be a safe buying point. It could be the final push before exhaustion. Therefore, although the golden cross above the zero line is strong, investors shouldn't blindly chase the rally. A smarter approach is to assess whether the stock price has undergone sufficient correction, whether trading volume has shown healthy expansion, and how close the upcoming resistance level is. To summarize, a golden cross below the zero line often suggests a rebound. A golden cross near the zero line often suggests trend continuation. And a golden cross above the zero line may suggest strong momentum. But you must avoid blindly chasing high prices. As you can see, a simple golden cross carries entirely different implications in actual trading scenarios. AMACD, death cross does not mean sell immediately. After golden crosses, let's talk about death crosses. Many people sell immediately when they see a MACD death cross. But if you do that, you may often sell too early. Because in an uptrend, a MACD death cross may simply be a short-term correction. It does not always mean the trend is over. Once again, we need to examine the location where the death cross appears. The first type is a death cross above the zero line. If both DIF and DEA are above the zero line and a death cross appears, it usually means short-term bullish momentum is weakening. But it does not necessarily mean a trend reversal. Especially when the price is still above important moving averages, this kind of death cross may simply be a normal pullback within an uptrend. Therefore, a death cross above the zero line primarily serves as a warning. Short-term risks have increased. Refrain from blindly chasing price rallies. If you are already profitable, consider reducing your position or raising your take-profit level. However, it's not necessary to sell everything immediately upon detecting a death cross. The second type is a death cross near the zero line. This signal deserves more caution, because the zero line is where bullish and bearish forces often shift. If the price breaks below key support while MACD forms a death cross near the zero line and the green bars begin to expand, it may indicate that the trend is weakening. The third type is a death cross below the zero line. This is usually a signal of continued weakness. If MACD is already below the zero line and the price is also trading below the moving averages, another death cross may mean the rebound has failed and downward momentum is strengthening again. In such circumstances, don't rush to buy at the bottom just because the price appears to have fallen significantly. Many stocks don't necessarily rise after falling sharply. Instead, they may continue to decline even in a weak market. So the practical logic is this. A death cross above the zero line may only be a correction. A death cross near the zero line warns of possible trend weakening. And a death cross below the zero line often means weakness is continuing. MACD, histogram. Assess the momentum, not just the color. Now let's talk about something many people ignore. The histogram bars. Many traders only look at golden crosses and death crosses, but they overlook the red and green bars. But in real trading, the histogram is very important because it reflects changes in market momentum. When red bars become longer, bullish momentum is strengthening. When red bars become shorter, bullish momentum is weakening. When green bars become longer, bearish momentum is strengthening. When green bars become shorter, bearish momentum is weakening. But this does not mean red bars equal buy and green bars equal sell. What really matters is the change in momentum. For example, if a stock is rising and the MACD red bars keep expanding, it means upward momentum is still strengthening. But if the price keeps making new highs while the red bars become shorter and shorter, it means the price is still rising, but the strength behind the move is weaker than before. At this point, vigilance is warranted against the depletion of momentum at elevated levels. Conversely, if the stock price continues to decline while the MACD's green bars keep shortening, it indicates weakening downward momentum. This doesn't mean it's available for immediate purchase, but it suggests that the bearish momentum may be nearing its peak. Therefore, the most crucial application of red and green columns is not to judge by color, but to determine whether the momentum has strengthened or weakened. If you used to look at MACD only through golden crosses and death crosses, I suggest saving this video. Real technical about memorizing signals. It is about understanding the market forces behind those signals. MACD divergence. The most valuable indicator in practical trading, yet also the most prone to misuse. Now let's discuss the most critical part of today, the MACD divergence. Deviation is a crucial signal in MACD trading practice, yet it is also the most prone to misuse. Let's first explain what divergence is. In simple terms, prices and indicators are not synchronized. The price has reached a new high, but the MACD has not reached a new high, indicating a top divergence. The price has hit a new low, but the MACD has not. This is known as a bottom divergence. What does dorsal deviation indicate? The price is still rising, but the upward momentum has weakened. What does a bottom divergence indicate? The price continues to fall, but the downward momentum has weakened. However, note one key point. A divergence is not a buying or selling signal. Deviation is merely an early warning signal. Many people immediately buy upon seeing a bottom divergence and sell upon seeing a top divergence, which is actually very risky. In strong trends, divergences can accumulate repeatedly. For example, during the rally of a top-performing stock, the MACD may exhibit a top divergence, yet the stock price can still continue to rise. Even during a strong downtrend, a bottom divergence may occur, yet the stock price could still continue to fall. Therefore, deviation cannot be used alone. It must be accompanied by a confirmation signal. How to use top divergence? Let's start with the top divergence. Suppose a stock has risen significantly in value recently. During the stock's initial surge, the MACD's red histogram bars were exceptionally long, with the diff indicator reading at a very high level. Subsequently, the stock price corrected, then rose again, ultimately breaking through its previous high. This time, however, the MACD's red bars are shorter than before, and the diff reading is lower than previously. This is a classic top divergence. What does this indicate? The stock price appears to have hit a new record high, but the actual driving force behind the rally has weakened. At this point, you shouldn't simply interpret it as an immediate, sharp decline. Instead, you should recognize that the upward trend is beginning to carry risks, and you can no longer maintain the same aggressive, bullish stance as before. In actual trading, when a top divergence appears, you can proceed as follows. If you are holding positions, you don't need to close them immediately, but you can start taking profits in batches. If the stock price subsequently breaks below key support levels, such as below the ascending trend line, below the 2-0-day moving average, or when a MACD death cross is confirmed, it is advisable to further reduce positions. If you're an observer, once you spot the top divergence, stop blindly chasing higher prices. Top divergence is best suited for risk warnings, rather than for precise top avoidance, because there is no indicator that can guarantee you'll sell at the highest price. What truly matters is whether you can safeguard your profits when risks begin to rise. How to use the bottom divergence. Let's talk about the bottom divergence again. Suppose a stock has been falling continuously. When this stock hit its new low for the first time, the MACD's green histogram was exceptionally long, with the diff indicator at a very low level, indicating strong bearish momentum. The stock price initially rebounded briefly before falling again, eventually breaking below its previous low. This time, however, the MACD's green bars were shorter than before, and the diff was also lower than previously. This is the bottom divergence. What does this indicate? While prices continue to hit new lows, the downward momentum has begun to weaken. At this point, many people become extremely excited, believing an opportunity has arrived and immediately rush to buy at the bottom. However, I would like to remind you, a bottom divergence does not necessarily indicate a reversal. A bottom divergence merely indicates that the downward trend may be nearing exhaustion. If you really want to buy, it's best to wait until you've confirmed. What can the confirmation signal be? For example, the stock price has once again surpassed the short-term moving average. For example, the MACD golden cross. For example, a breakout above the descending trend line accompanied by increased volume. For example, a clear bearish reversal candlestick pattern appears at the bottom. For example, prices have stopped hitting new lows and are beginning to rebound from previous lows. If there is only a bottom divergence, yet the stock price remains in a downward trend with moving averages still in a bearish alignment, there's no need to panic. The greatest fear of bottom fishing isn't failing to catch the lowest price, but buying during a sustained decline. Therefore, the correct application of the bottom divergence is: first, identify the exhaustion of bearish momentum. Wait again for the price to confirm a stronger trend. Finally, consider entering in batches. These three steps are all indispensable. MACD practical strategy combination. Trend plus position plus signal. At this point, we've integrated the practical application logic of MACD. When examining the MACD alone, it is easy to make a misjudgment. A better approach involves three dimensions. First, observe the trends. Second, check the location. Third, observe the signal. First, look at the trend. The stock price is above the moving averages, and the moving averages are trending upward, indicating a bullish outlook. The stock price is below the moving average, and the moving average is trending downward, indicating a bearish outlook. Now let's look at the location. The MACD is above the zero line, indicating an overall strong market trend. The MACD is below the zero line, indicating an overall weak trend. The MAD is near the zero line, indicating a shift in market sentiment between bulls and bears. Finally, check the signal. Golden crosses, death crosses, changes in red and green bars, and divergences are merely auxiliary indicators for analysis. In other words, you shouldn't start by asking, has the MACD formed a golden cross? You should first ask, what is the current trend of this stock? Is the MACD above or below the zero line? Where does the golden cross appear? Are the red and green columns being enhanced or weakened? Is there any deviation? Has the price been confirmed? This is practical thinking. To sum it up in one sentence, MACD isn't designed to predict the future. It's used to monitor trends and changes in momentum. A golden cross is not an impulsive buy order. A cross signal does not mean you should sell blindly. The red and green columns indicate the strength of kinetic energy. The divergence indicates trend exhaustion. The zero axis determines the quality of the signal. The price confirmation determines whether action can be taken. If you only need one mnemonic rule, it's first observe the trend, then check the zero line, and finally examine the signals. Do not treat the MACD as a standalone trading indicator. Instead, integrate it into a comprehensive trading system. In the next episode, we'll continue our discussion on the most popular technical indicator, RSI. If you want to deepen your understanding of technical indicators, stay tuned. We'll pick up where we left off. Follow me, and we will keep watching the market together. Not chasing emotion, but breaking down the logic.